Now, what is the market structure exactly? Market structure refers to swing highs and swing lows, supply and demand areas, order flow, and overall market condition. We have two market behaviors, trending and ranging market. In an uptrend, as the name suggests, the market moves towards the upside, creating new higher highs and higher lows. Here, you see an ideal ascending structure. The ideal means that the market respects the lows and continues pushing upwards. The important point is that in the uptrend, the market has a greater tendency to break the highs to the upside. Although the market might not always move this clearly, this is the general definition that is commonly seen in the market. Even if you look at the 1-minute chart, you can see that the upward movement is created by making higher highs and lows. So, as long as the price continues to break the structure levels to the upside, we are still in an uptrend. Now that we've talked about breaks, let's see what breaking really means and what conditions we consider in a break of structure. But, before everything, this is the general anatomy of a candlestick formation on the chart. They might come in different sizes and shapes. However, they become an important subject when we are talking about breaks and liquidity concepts. Structure and liquidity are two inseparable parts of the market. Many liquidity areas find meaning through structure, and many structure levels become invalid with liquidity concepts. It can be hard to understand, but we'll cover it all today. Now, how does a breakout occur? A breakout occurs when a candlestick clearly breaks the previous market structure with the body. This means that if the price can close a visible amount, like a couple of pips above the previous level, we would have a so-called break of structure. But here comes an important point. How can we ensure this break is valid, and not just a liquidity grab? In case of a fakeout, or liquidity sweep, the price immediately gets back into the range. So, let's make our concept more advanced. If the price wicks above the previous market structure and closes back inside the range, we won't have a valid breakout, which we previously discussed. But in order to have a valid break, the following candle needs to close above the previous one. This is a strong sign that the sellers have failed to push the price back inside the range, and the buyers are in control. Similarly, a double confirmation for a break of structure with a closed body would be to wait for the following candle to violate the highest point of the previous candle. This indicates a strong continuation momentum to the upside rather than a liquidity grab. Remember, everything we discussed here is applied to the bearish scenario as well. Now let's move on to the next topic, which is the major and minor highs and lows. When is a swing high or swing low considered strong, and when is it considered weak? In an uptrend, strong lows are areas where the break of structure movements originate. So here, this is the highest point that the price has recently reached. If this low can break the structure levels to the upside, it becomes a major swing low. Otherwise, if it fails to create a new higher high and the price pushes lower, we consider it a minor swing low. Now here comes a question. Does breaking above this high make this point become a major swing low? Well, the answer is no. According to the definition of a major low, we only consider the break of the highest point that the price has recently reached. So after this break of structure occurs, this low becomes a strong or a major low, and as long as we stay above this level, we are still in an uptrend. These points, when they are formed, are referred to as origin points, the points that were the source of impulsive movements in the uptrend. To identify a reversal, we examine the origins, and breaking below the last origin is sufficient for us. The same concept is applied to bearish scenarios. In a downtrend, strong highs are areas where the break of structure movements originate, the points that were the source of impulsive movements to the downside. Breaking above the recent origin point signals a shift in market momentum. Now, let's move on to the next topic, trend reversals and change of character, which is a bit complicated. One of the most critical concepts in identifying the trends and reversal points on the chart is liquidity. Talking about liquidity, generally, there is liquidity above the top and below the bottom if we consider this as the market structure. The price has more tendency to grab the liquidity below the recent low, and then continue pushing higher to grab the liquidity above the recent high. But most of the time, liquidity is used for trend continuation. This means that in a bullish market, we usually witness the price sweeping the liquidity below the lows to gather the fuel for upward movements. Candlestick formations are important in identifying liquidity sweep movement. In the bullish scenario, a long wick at the bottom of the candlestick represents a liquidity grab movement. Imagine if this area is our previous support, so we have lots of buy orders gathered here, which means that the stops are somewhere below this level. So, a long wick breaking through this area is considered a liquidity grab, but only if it won't have a long wick at the top as well. This would be a great sign that the price can start its movement to the upside. It is not possible to define a mechanical structure for all cases, but what we want to see is a wick penetrated through the level and quickly returned. However, this wick should be at least half the size of the body. Now, we have mentioned previously that for a reversal, a source must be broken. But here is an important point. When we combine the liquidity concepts with market structure, a liquidity sweep above the higher high is also considered a sign of possible reversal. For example, here we have the recent source that has broken the market structure to the upside. When price sweeps the liquidity above the recent higher high and fails to create a new high, this is considered a sign of possible reversal. Liquidity sweep against the dominant trend is very different from liquidity sweep in the direction of the trend, meaning that grabbing the liquidity above a high represents a temporary reversal, but we do not expect the price to drop much. A true reversal is confirmed when the price breaks and closes below the most recent origin point. Then, we can confirm that the uptrend is truly over, and the price can continue pushing lower. The same concept is true for the bearish scenario. Sweeping the liquidity below the latest low indicates a possible short-term reversal for the dominant downtrend. From the price action view, the sellers have failed to create a new low, which shows momentum loss. When the price immediately gets back inside the range, it indicates upward momentum, which has the ability to push the price to the supply level in front of the price. And if the price breaks above the origin point, the reversal is confirmed, and we have a change of character. Here, we have gold in the 5-minute chart. The market sentiment is bullish, and the market continuously makes higher highs and higher lows. These equal lows are the source of the break of structure movement and contain lots of liquidity. Therefore, a liquidity sweep pattern formation at this level serves as a strong upward continuation signal. On the contrary, forming a liquidity sweep pattern above the highs signals that a temporary reversal is coming. This reversal is later confirmed by breaking below the recent source point that has led to a break of structure. Then, we can expect the price to change the direction and possibly continue pushing downwards. Practicing these concepts on your chart will definitely improve your chart analysis, help you understand the fundamentals of price movements, and optimize your trade entries. So guys, I hope this video provided value to you. If it did,